Well, with just 12 days to go until the big day, that is the US election, we are seeing the US dollar rip higher. But we try to quantify just how much Trump trade premium, the tariff risk, is being priced into the US dollar as well as other markets, especially with some key event risks coming up as we go into November. As I say, we are seeing a bit of a backup in 10-year Treasury yields, and that may be having an effect on equities. We have just seen a bit of a liquidation of some fairly extended long positions playing through. And we chart what was happening in the technicals in equity markets, FX markets, and other asset classes as well. It's all going on today. This is the trade off. Hello, I'm Chris Weston, Head of Research here at Pepperstone. I'm going to be joined in 2 seconds by Blake Morrow from Forex Analytics. We will be discussing the US election, trades around that, as well as other asset classes. I know you're thoroughly sick and tired of hearing about the US election. Unfortunately, it is an event that we will need to manage risk around. So I think it's good to be prepared, even if you're not really looking at that situation too much and you're a staunch price action technical trader or even running an algo. It will affect our market conditions. We're already seeing situations where it is affecting the liquidity conditions in some of the FX markets, which is exacerbating some of the moves we're coming through. But of course, there's other things going on as well. So, Mr. Blake Morrow, would you come into the program? Obviously, you are living and breathing the election. It's a painful thing to do. I don't think it's really properly beefed up yet in terms of the news flow. How does it feel on the ground over there where you are?
Oh, well, you're asking where I live. We're pretty red over here where we live. So we're in, I'm in Trump territory, I would say, where in my neck of the woods, that's where our folks lean. But, on boots on the ground, I mean, it's contentious. It's nonstop. You have anywhere you look, if you try to watch American football on television, you just get plastered with ads. It's a little much, and I'm ready for us to get past the next 2 weeks.
You're getting
That's
text messages bombarding you from different policy, announcements and bits and pieces, and
probably about no less than a dozen a day, Chris.
Jesus,
no less.
Yeah, we don't really get that over in here in Australia, and certainly not in the UK when I was back in there. But yeah, it must be painful. I bet you can't wait to get it over and done with. Anyway, unfortunately, it is something that we will need to live with. So it's probably a good idea just to sort of go through some of the conditions we're seeing in the markets and assess some of the trades that are going on. And let's go into topical thunder. Let's go to US election now. Yeah, obviously the betting markets have swung to a very convincing belief that Trump's going to win. I know a lot of people out there, see a number of massive trades distorting the odds, and some people have suggested that Trump's campaign trail may be using the betting markets as campaign policy and promotional policy. I'm not quite sure why Kamala Harris hasn't done the same situation. I think the polls tell a very different story, though. If you have a look at the average of the polls from Real Clear across the 7 key swing states, they're all pretty much within the margin of error, which says, yes, it's going to be a very tight race indeed. And we could see some contested elections across those states, recounts, which could delay the result a little bit there as well. But, if I look at the underlying market conditions, the liquidity conditions, we are starting to see a thinning out of the top of order book, which those poorer liquidity conditions can lead to more exaggerated moves and more violent moves as big trades get filled and move the price. You're seeing that in the volatility space at the moment, Blake. 2-week vols, implied volatility in dollar MEX, dollar CNH, the offshore yuan, all the MEX pairs really, right up into the top 100 percentile of multi-year range at the moment. So people are hedging, tariff risk and various factors through the vol markets. I'm interested to know your opinion now. We've had about a 4% move up in the dollar index. A lot of it's justified by the rates markets, with better growth in the US, rates pricing being priced out, the ECB turning dovish. Yeah, how much of the Trump tariff trade, which obviously he can pass a lot of the trade tariffs without the use of Congress if he is to get into power. A big if, of course, but if he was to get into power, tariffs are the big thing everyone's going to be talking about in a split Congress. How much do you think the dollar's now pricing in, tariff risk against, pushing up tariffs to 60% on Chinese imports and 10% blanket? How are you quantifying? How are you seeing the spot FX markets pricing in that at the moment?
I think there's more to go. I believe there's more to go, Chris. And that's not to say that we're going to get it. I'm just saying that the moves following the election are going to be big. You and I, we discussed last week the dollar Mexican peso, and I think it's a clear indication of what's going to happen, and it's going to be very binary, as you pointed out. The volatility and what traders are buying into that volatility in the dollar mex, I think makes a lot of sense. Question is, are we going to get this move ahead of the election as people get a little nervous? And remember, before you guys make decisions, remember, you all live in your own echo chamber to a certain extent. So don't get super excited about like, oh, I think Trump's going to win, or I think Harris is going to win, or this is exactly what's going to happen. Remember, you guys do live in your own world, in your own bubble, and you hear what you want to hear, and just take a broader scope. And that's why I'm like, I kind of think the dollar Mexican peso very much is in the middle of a triangle. You can see very, very tight consolidation. It hit the top of the triangle today at 20.07. And we need a clear breakout of 20.25 to suggest that the market's really starting to price in a Trump presidency, which could happen before the election. But I was reading, Chris, about, one analyst is like, oh, yeah, on a Trump win, we might go to 20.50, and a Harris win, and this is dollar max, we'd go to 19.50. I'm like, I don't know what kind of weed that guy's smoking, but personally, I think we could be trading up at 21 to 22, and I think we could get a break of this triangle ahead of time if Trump stays higher in some of these betting odds markets. And so that's one clear indication of like, how's the market leaning, is the dollar max. The other one that I would be closely watching is Bitcoin. Bitcoin failed at 70,000. If Bitcoin starts raging above 70,000 on a breakout, that's telling you the market's really leaning into the pro crypto Trump campaign, Trump administration. We haven't seen that. We've seen it back away from 70,000. It isn't breaking down. It's holding above 65,000. But those, I think, are the markets that are really going to tell us which way the market is leaning. And right now, I think it's very kind of like the polls, 50-50.
Yeah. I want to just jump in, Chris. I know we've got to go to the next section, but dollar CNH is the one for me as well. I mean, 2018, tariffs came up 10% to start with, and then they went up to 25%. But the PBOC depreciated the yuan by about 11% over the year, or over the next 5 months. So one suspects if they're going to go 60% tariffs, then they would have to depreciate the yuan. I don't think that's priced in at all. But when I look at the US voter, and I don't know how you feel about it, I think it's a one party fits all. Like for me, if I'm going to go and vote for Trump, I'm also going to vote for a Republican senator, and a Republican House person as well. I just don't like the idea of splitting. So for me, if Trump's going to get in as president, the Republicans are probably likely to get the House and the Senate in that situation. And I don't think that red wave is. You want to correct me, don't you?
I do, not necessarily, but I agree. Down ballot voting. All red, all blue, however you're going to vote. But there are some of these swing states. You take like where I live, and I'll just use the two congressmen, women that I know that's right in my backyard, Carrie Lake and Gallardo, or I'm trying to think of his name right off the top of my head. He's an ex-Marine too. He's a former Marine, but she is so unliked in our where we live. I mean, Garlado. Anyway, he's forecasted like, and he's a Democrat. He's looking at like 80% chance of winning. So I think it depends on some of the swing states. That's why I understand a red sweep seems logical. But that's why we're going to have to keep our eyes and ears open on election.
Yeah, well, I think it doesn't. Yeah, either way. I mean, I think if we were to get a red sweep, which I don't think is being priced at all. I mean, Trump can go hard on tariffs, much harder on tariffs, much more broad. Obviously, it opens up then a lot of the fiscal policies, deep-rooted fiscal spending, and taxation. I think all of those situations would be significant, and that would drive markets. It's not priced at the moment. You'd see a decent backup in 10-year Treasury yields, and ultimately, I think Trump would have to use tariffs to raise revenue. At the moment, I think there's a debate: would tariffs be a negotiating tool, or or are they actually there to raise revenue? If he's going to go out and do massive fiscal spending and blow out the deficit, he'd have to use tariffs as a revenue raising tool. He'd have to go really hard, and I think that opens up decent volatility in the financial markets. Anyway, let's move on.
Yeah, well, let's stick with politics, and I know our producer's probably going to kill us right now. So let's talk with the Japanese political environment. You know, we have a Shiba who's going up for the vote this weekend. Now, let me take a step back. My team over at Forex Analytics, they've been talking a lot about this, and they're thinking that the yen, the weakness in the yen, is also being factored in because of the LDP, losing some of its majority, and looks like they're slipping in some of the polls for the weekend vote. Now, that really comes down to the trying to think of the name. Komedo, I believe, is the other party that he'd have to form a coalition with, but he might actually lose and could threaten him as even being the leader of Japan, the next prime minister of Japan. And I guess that's where the fear is, because you had Ishiba and Kishida, and Kishida was going to really weigh on the yen. And if Ishiba is gone, maybe, that opens the door for new leadership, and one that could have a little bit more influence on the BOJ. So anyway, I was just wondering how that much is factored into your idea with what's been happening with the yen, because the yen has been getting smashed, but I think that's been more of a yield play.
Yep.
But I think there are some risks this weekend. What are your thoughts?
Obviously, our job as traders is to manage risk. It's one of the primary jobs that we have. And obviously, when you're going into the weekend, you've got to look at that situation that you can't control. Markets are always moving 24 hours a day, 7 days a week. You just can't trade them. The news that comes in means that you've got a hypothetical move going on. And therefore, you see it opening higher or lower with the gapping risk. So, does this pose gapping risk? Yeah, like maybe to an extent, depending on the outcome. I wouldn't necessarily be closing my dollar yen positions, whether I'm short or long, going into the weekend based on this, because, one, it's been speculated on for a while, but two, I think it will be forgotten about pretty quickly. I mean, the question we've got to ask ourselves, Blake, here is how much influence does the government or the political parties have on the BOJ? Or rephrase that, how much independence does the BOJ have? And I think that they do have the independence there. I think, we've seen and heard from various members of the LDP party recently, and they've all suggested that they want to refrain from putting too much influence on the Bank of Japan. So I think once this is done, you might see a bit of a movement play, and that may affect if you're leveraged up. But for me, if you're trading dollar yen, obviously focus on price action. They'll tell you everything you need to know. But it's more a yield play. So I would be more, if I was taking this as a sort of a more tactical, longer term trade, using a wider stop loss, letting it run a little bit hotter. I'm thinking to myself, what happens in the election? I know it's still a long way away. 12 days in the FX market's an eternity. But for me, it's if we were to get a red wave, and I'm betting markets pricing at 50-50, which whether we can use betting markets as a signal is obviously a point of conjecture. But if we were to see the red wave, yields would spike up, and dollar yen would be your cleanest play on that. And that's what I'll be looking at much more closely. So get the election out of the way, and then we can move back onto election risk and obviously US fundamentals. But what do you take contention with that point?
No, I just, what I want to say, Chris, take a good look at 2016, November 8th and 9th of 2016. I think that'll give you a good analog on how to approach the markets. It's when Trump beat Clinton. And that, I think, just do your homework and go back and take a look at what happened there the days following.
I remember literally just as that was going down, I got a call from my son's daycare center, literally just as it was coming out, saying, your son's banged his head and you need to come and pick him up. And I was like, have you spoken to Mrs. Weston? And they said, we can't get hold of her. And I said, all right, okay. And you obviously got a duty of care and to drop everything and go and pick him up. So I said, can you just look after him for another hour? They said, no, you need to come right now. So I've told my boss on the trading floor, and he's like, everything's just blowing up now. Like, phones are ringing, every markets are moving. Trump's just got in. He was given a 15% probability on some places, 35% on 538. And I've said to my boss, I've got to go home. And he says, you are not going home. You're staying right here, right now. I said, well, I've got to go and look after my son. He said, no, you've got to stay here. tell them to do their job and look after the kid. I can't do that. So I'm about to walk out. Luckily, I got a phone call from Mrs. West. She says she's on her way. But yeah, I was just like, everything's blowing up and I had to leave. And, obviously you're always going to put your son before work. But I remember my boss, I said to him the other day, I said, do you remember when you said I couldn't leave during that situation? He said, yeah, I regret saying that now. I said, well, you've had 2 kids. But yeah, it was absolutely blowing up. Yeah, S&P futures were limit down because Trump was supposed to cause chaos around the world. He stands up on the pedestal, starts speaking. Everyone says, oh, the guy sounds a bit presidential. He's about to chuck out a load of fiscal stimulus. And then suddenly we saw this ripping V-shaped bottom in the S&P futures. Bang, up she goes. And suddenly all the phones are absolutely off the hook. It was a day I'll never forget. But anyway, let's move on to the US bond market, because what we have seen is a big backup in long-term yields. We've seen that the 10-year trade from 359 up to where we're up about 424. So it's a big sell-off playing through. A lot of that, I think, has to be down to the rise in term premium that we've been seeing. A lot of it has to be down to the US growth expectation, the better data we've been seeing. Obviously, a lot of it has to do with the repricing of rates. If you have a look at the trough in US rates, SOFR's moved up by about 70, 75 basis points. So the low point, the expectation of the low point of the Fed cycle has moved up significantly. We call that neutral rate. All these factors, you can chuck in supply. I mean, the Treasury Department have been chucking out Treasury issuance left, right, and centre. And of course, that means the private sector has to go up. But, I think this has been the primary driver of the dollar. Rate differentials has been moving up, yields move up. We've seen a bit of a steeper curve. How worried are you? A lot of people are talking about this move up in the 10-year, and whether the discount rate is causing present value on equities to fall and all these factors. But are you concerned about this move up in the 10-year here?
Yeah, how are we going to service that debt, Chris? I mean, so yes, and
issue more debt.
Yeah, I guess we just, we do some sort of quantitative easing, I guess. I mean, I don't know. I mean,
well, I don't know. The big issue here, I mean, like the Fed are never going to have any problems because they just print more money, don't they? But the big issue for me is what's happening in the funding markets now. We are seeing, concerns as we head towards year end about, SOFR and all these other factors, and liquidity in the funding markets. Not necessarily a function of 10-year, but as dealer balance sheets become more constrained, you do see deleveraging in the 10-year, and that pushes yields up as well. So I think that does represent a time financing conditions, considering as inflation expectations haven't moved up as much, and therefore real rates are moving up. So I think that it will start to bite a little bit. And if Donald Trump does, I think does. I'm no political bias because I don't have a dog in this fight. But if he does go up, I think, and he chucks out fiscal left, right, and centre, then the bond market will be definitely worth a look, because he needs to offset some of those fiscal measures with revenue at the end of the day.
So, I mean, in this world of yours, Chris, that you have no dog in the game.
It's a dark, sinister world.
It is dark. That funding issue becomes more of a dollar issue, and that's where the dollar demand really comes in if rates continue to go higher, and the 10 or the 30 or the 20-year really starts to slump. Is that correct?
I know a lot of people in the zero hedge world are really worried about the interest expense that the Treasury Department have to pay, and obviously they need to issue more bonds. I have no concerns about the US's fiscal issues. I've got no concerns about the Treasury Department, this, that, and the other. What ultimately happens is, and next, we're coming up to the next quarterly funding review for the Treasury Department, where they talk about how much issuance they're going to be coming out and their projections for that. But at the end of the day, when you've got a situation where the Fed is still doing QT, the private sector are asked to buy the bonds that the Treasury are issuing. They need to fund the US government, and if there is increased supply because they need to fund more, then the private sector are going to be asked to take that down, and they'll want higher yields to compensate for the additional supply. And high yields, depending on how high they go, are a problem. They will be a tightening of conditions. That is the cost of capital, and I think that could be something. I don't think it's a problem now, but if we see this ripping and people do start to get more concerned, it will be a function of what happens, and pushes the dollar up, and I think it could be a handbrake on the US economy for sure.
All right. Well, the last topic, and boy, we've talked quite a bit today. We're going to talk about the BRICS summit. Let's discuss this just because, and we're going to discuss this kind of lightly. This is the first BRICS summit where you have the UAE, I believe Iran, is it Ethiopia? Ethiopia and Egypt, I believe, are the new members of the BRICS, coalition, if you will. There's been a lot of talk, and this is one of those, every time they have a BRICS meeting, people will start worrying about the dollar. And I've had a couple of conversations just outside of my normal sphere of people talking about it here. And maybe people are a little bit more sensitive being here in the US. They talk about what's happening in the dollar and what's going to happen. And I guess with with gold going higher and silver going higher, and so everybody wants to talk about BRICS. I still think it's I don't believe it's more, they're just talking points, but I do believe there is a concerted effort amongst, different countries where we're becoming more segregated in the world, a dollar-based world and a segregated world where call it the BRICS, that they're going to eventually be moving some of their reserves over, dealing amongst themselves, and they're going to have less dependence on the dollar. I believe that to be happening longer term. And I do believe we're going to fall into the same trap that we did during the financial crisis of 2008, when the tide goes out and everybody looks around and, we see whose pants are down and who doesn't have enough dollars. And then next thing you know, the dollar comes in demand because of some sort of crisis. I still believe that to be the case. Some people might know it as the dollar milkshake theory, if you will, we saw it in real time during the financial crisis. Does the BRICS meetings have anything? Do you factor that into what you do longer term?
Absolutely no, I don't at all. I mean, the things I'm working day to day. To be honest, it's like you say, this is a slow moving ship, and the dollar's reserve currency status is going to be there for a long, long time. I do take point that it could be part of the reason why we're seeing gold moving up. The fact that the US, did shun Russia away from its dollar liquidity and all those factors, and some other banks around the world, reserve managers on behalf of governments who may be saying, well, we're not so friendly with the US, maybe thinking, let's take away our dependence away from the dollar just in case that happens, and maybe that's part of the reason why we're seeing gold doing what it's doing. I do agree that we are seeing segregation, and the splits and those tectonic plates are moving at a slow pace, but they are evolving in that way. But it doesn't affect my thinking at all. I mean, it is something that just happens on a glacial basis. It's not going to be something that really bites home for a number of years. So I think it's an interesting story just to see how the relationships of the world are all sort of moving and evolving, and maybe that's something that will have huge implications longer term. But it's not something I think day to day. Right now, it's just election.
Where's the resistance in the euro dollar right now? That's what I want to know.
So it doesn't change our market. The thing is for traders, does it affect our market conditions? Does it affect intraday volatility? You can say there's some factors that are pushing gold to where it is at the moment, but they're very opaque, and they're just hypotheses. There's not really a huge amount of tangible fact at this stage until we actually get the data through.
And if you're sitting there day to day thinking that there's going to be a collapse of the dollar at some point, that's kind of like, at some point we're going to get hit by a meteor and we're all going to die.
You said it. If something really bad happens left of field, we get a black swan event. Markets crater 20-25%. VIX goes up to 50%. The Fed just go dollar swap lines. Everyone wants dollars. Give me dollars. Give me dollars. Until that dynamic changes, we're not worried about it. So the dollar's there. The dollar, my friend, reigns supreme across all different.
I was born in 1972, so you guys all know my age. I looked at the dollar index in 1973, and it was 98, and today it's 104. Just
there you go. Anyway, let's crack on. Let's go to this setup. All right, we just used a lot of time up there, so we're going to rip through these ones. I'm going to start with euro dollar. Right, what I've got here is a chart of euro dollar, and I've overlapped that against relative rate expectations. So you can see, hang on, which one is it? It is the white line, which is the difference between euro 1 year forward rates and against the US dollar, US 1 year forward rate. Essentially, what that means is we're looking at what's being priced into the European markets, the European markets in terms of rate cuts over the next 2 year period against what's priced into the US curve over a 2 year period. So when we're seeing that blue line going down, essentially what we're saying is the white line going down, sorry, is we're saying that the US rate cut expectations are increasing more than what we're seeing in the US. So rate cut expectations in the US are getting priced out. Rate cut expectations in the euros are going down. And you can see that there's a very strong correlation between euro dollar there. So for me, when I am trying to quantify the risk of the trade premium that's being priced in, trade tariff premium that's being priced into the rates markets and euro dollar, really I'm just seeing here right now is that the relative rate differentials are what's driving euro dollar right now. So I don't think there's a huge amount of US election premium priced in. I mean, that's what I'm trying to show here. So the question is can we get more juice in the rates trade? Can we see US rate cut expectations increasing relative to what we're seeing in the US? And I think absolutely we can. But this proves to me right now that we don't have a huge amount of US election risk being priced into the dollar. It's mostly in the vol space, in the volatility space. And right now, these rate differentials are driving. You can just use a 2 year treasury, for example, German 2 year treasuries against US 2 year treasuries as the yield goes down relative to that of the US. But yeah, that's what's driving me. So yeah, do I think an election with Trump win with an election with a split Congress is priced in to an extent? It would have more to go. Do I think a red wave is priced in? No. Obviously, if Harris was to come in this situation, you might see a bit of dollar selling and some of that positioning gets unwound. But I don't think a red wave in any capacity is priced at this point.
Well, Chris, my team's actually using the two year euro.
They both do the same thing.
Basically, the same chart, and it's great. I think that it's great that you guys can really identify that. Hey, this is really a rates trade at this point. But I'm going to tell you, I got two election trade setups for you. So let me give you my first one. And this is the dollar index. And what you're going to notice is that the high upper left-hand corner of your screen, that is the high from 2022. Then you can see the previous peak, and you can see right where we're at. We clawed above the 200 DMA this week. We're getting close to the 78% retracement in the US dollar index. And I believe we're at a very pivotal level. Now, I'm not saying that we can't break higher ahead of the election. If the market wants to price in a Trump presidency and you start to see it come in through the dollar index, it could come in right here. What I think, let me rephrase this. What I hope happens is I hope the dollar actually pulls back from current levels, maybe back below the 200 DMA, which isn't very far away. You're talking maybe about 103.70, and consolidates there ahead of the election. Because if that does happen, I believe a break above today's highs, which happen to be 104.70, I believe, or 60, somewhere around there. We break above that, it's a clear-cut buy post-election. That means Trump won, red wave, however you want to look at it. And if we get a reversal from current levels, you know where your risk is if you're going to play, a short dollar, Kamala Harris win. At least what we think is an uncontested win. Who knows? But I think that's a great setup, I believe, going into the election. Where we are in, like Chris said, less than 2 weeks is still an eternity in the FX market. I just hope we back away from this level near term.
Yeah, let's go to the HK50, the Hang Seng essentially. Now, I think this is an interesting one. We've got a triangle pattern. Don't take away this idea it's a triangle pattern. I mean, it's just people say, just because it's got a silly name that, what you're seeing is consolidation after a big fall. That's really essentially what you're seeing. And the price action mimics and marries beautifully with the backdrop that we've got coming through in the fundamental space as well, because you're making lower highs and higher lows. So we're essentially consolidating. The market just doesn't know what the hell to do with the Hang Seng. It's trying to find a fair value is ultimately what we're seeing in the price action. And it marries exactly with what we've got. So we've got an MPC meeting coming through at the end of next week. into the end of the month, the National People's Congress. Now we have these kind of party meetings all the time, but this one's going to get a lot of focus because we've seen a lot of fiscal measures being announced. We've seen a lot of monetary measures being announced, a lot of stuff to try and take the shackles off local governments and access special government bonds. So they can use those proceeds to help housing, buy back inventory, a lot of money going into the stock market. But the rubber meets the road here. We need those answers. We need clarity of a lot of those measures that have been announced. They've given us the rough outline. They need to give us the picture. That's why we're seeing consolidation. We should, or the market is expecting a lot of the announcements, the finer detail on how this is all going to work, the mechanism at that meeting. If they're disappointed, you're going to see a nice breakdown of that triangle to the downside. People are going to express disappointment, as we've seen before. However, if the market says, hang on a sec, this looks like it really could work, we could see animal spirits being driven and we could see reflation playing through over a longer term period. It's going to take a long time. But if they like the plan, if it's got enough substance, you're going to see it break out to the upside. So I think that's going to be a really big one there for maybe to a small extent the yuan. But I certainly think if you're looking at the CN50, the Hang Seng, the H shares, that's going to be a big meeting, and you can understand exactly why the market is consolidating here in that pattern.
I love that setup, Chris. I know we've been talking about China the last couple of weeks, and it's really technically on a pretty big support. I like it.
Yeah.
So my next and last setup is also, I believe it's another election trade, and this is the Russell 2000. There's been a lot of calls for the Russell 2000 this year for some upside, and you can clearly see this is your CFD at Pepperstone. So you guys are Pepperstone traders. You can trade this CFD. I think it's good because I can actually give you what the levels I would be looking at on the CFD. Look at about the 2290 level. Yep. That would be your top side resistance. That's a 78% retracement. And obviously, if we're at the 50 DMA right now, but really it's that lower trend line that comes in around 21 and a quarter, maybe 21.30 if we drifted down there. And I mean, we have the recipe, so we think, right? Trump win, stocks would go higher, fiscal measures, tariffs, Russell 2000 would take off like a bat out of hell and just it'd race higher. Kamala Harris win. Some people believe that the markets were going to get a lot of the same, so we're not really going to get a sell-off, but others believe that we'd get a sell-off. Well, I think your breaking point is at 21 and a quarter. So I think this is a nice wedge. It's actually a bullish wedge when you have consistent highs and higher lows. But just because it's a bullish wedge doesn't mean it should break higher. It's just there's higher probabilities to the upside, and it seems like there's higher probabilities to a Trump second 2.0 second presidency too.
I think Trump with a split Congress is a negative for US stocks because if the only thing he's going to be able to pass is tariffs. He can't pass fiscal without the blessing of Congress, and if they doesn't have the House, he can't put through those countermeasures. So tariffs, obviously, if he goes hard on tariffs, and they've been in the epicenter. I mean, tariffs see the price level raised. That's going to be an impact on US margins, especially those high import businesses. They've got to choose how much of that they're going to pass on to the consumer. I don't think a lot, but there'll be a one-off hit to the to inflation. I think the Fed will look through it completely. I think they'll say unless inflation expectations become de-anchored, we're going to look through this one-off tariff shock that comes through. But it will layer on US GDP. It will impact company margins. So I don't see it as being a particularly big positive. Where it becomes really positive, and specifically for the Russell, is if we were to suddenly see that red wave, because those fiscal measures, the rollover of the Tax Cuts and Jobs Acts, a 1 percentage point cut to the corporation tax, deregulation of businesses, the Russell will absolutely fly on that. These inward-looking companies, the companies that produce domestically and sell domestically. Do you know what? If you get a red wave, it's buy America, except for the fixed income market, which is going to sell off. But buy everything America. Small caps will love that. But I think a split Congress would be a bit a net negative, because I don't think tariffs are particularly good for US equities because of the margin hit. But that's my view. Anyway, let's go to play de jour. Okay, so all right, dollar CNH. Let's go to the offshore yuan. Again, we just come back to the election. I know people get over it. We can't, unfortunately. Look, we've moved up back to this supply zone. yeah, 3% move up in dollar CNH is okay. Obviously, this is a managed currency. Well, to an extent, the offshore yuan there is a free floating currency, but it is really heavily affected by the CMY, which is a managed currency. So obviously, a lot of people choose to refrain from trading this. The spreads are a little bit wider, but it is very influential on the Aussie dollar. It can be quite influential on G10 effects as well. When dollar CNH is moving up, you do see the dollar typically having a rally against other currencies as well. So that's why we want to look at it. But what we saw in 2018 when we saw those Trump tariffs being put on, 10%. Then after a while, a wider range of group got up to 25%. As I said, the PBOC offset that taxation on them by depreciating the yuan by 11%. It was a significant move. Now, what we're talking here, what Trump's proposing, is a 35% increase in tariffs to China. If he is going to get a red wave, I'm saying it's a big if, but a lot of this is hypotheticals, and we're looking at the playbooks. As I say, if he puts through these fiscal measures, if he can pass them through Congress because he's got the red wave, then he has to use tariffs as a revenue driver. He has to do it, and that means he goes really hard on tariffs on China. And with that, the PBOC have to, in my opinion, depreciate the yuan. I mean, there's not they can come back with countermeasures and reprisals like they did before, but and they can switch supply chains and make alliances with other countries similar to what we saw in 2018-19. But I think the yuan would have to be depreciated. 35 percentage points is massive. It would smack the Chinese economy if they don't. So for me, if you think that Trump's got any chance in hell of winning this election, if you think that's going to be the case, and even if you just want to hedge out that risk, dollar CNH is the play for me there.
All right. Well, Chris, I think you got a really, really strong resistance level there to play off of. So nice play of the day. Mine is going to be, and I didn't want to call it my election third setup because it just isn't, but it kind of is. It's the US dollar Norwegian krona. And I didn't even give it a cool name, like, knocking on heaven's door or anything like that. I know, but we have this triangle consolidation, and it's been the spike highs are from the post-COVID lockdown. So if you take that upper trend line and it comes all the way back up here, you might have remembered back in August I was short US dollar Norwegian krona above 11. I actually had some orders out today trying to get short above, just a couple pips above where we got to today. And I'm trying to play this consolidation because I believe that post-election, we are going to be breaking out of this consolidation. Now, again, I could be wrong. The dollar might go on a run ahead of the election, especially if polls continue to favor Trump. Maybe in the betting markets, you might see the dollar Norway actually break higher. We do have Norway employment tonight. Well, tomorrow morning, if you live in Norway. If you're asleep in Norway right now, employment's going to be when you wake up. I doubt that's going to be the catalyst that breaks it out, but that could be the catalyst that gets us above 11, maybe towards 11.10, especially if it comes in a little light. However, I do think that this triangle will be able to be played ahead of the election, and then post-election, you have to be looking for a breach of the upper or lower end of the range. Anyway, I'm looking to play inside of that. I have no position at the moment, but that was the key term, at the moment. So
Elemental. All right, good stuff. Well, sorry, we've banged on a lot about the US election. Unfortunately, we'll probably do so next week as well, and probably the week after. So it was all consuming, but don't worry, it will disappear soon enough. But I think it's going to affect our market conditions, and it will get worse as we go into that. But obviously, keen to see your view. If you stuck around this long, thank you for joining us. We really appreciate. Blake, great views as always, and we'll see you back next week for more of the trade-off.